4 important things every business needs to know for the new financial year. This is the perfect time to make sure that you know everything you need to prepare for this next financial year. We want to touch on a few important factors that as a business owner you should consider for the new financial year. Number 1, super guarantee. Number 2, phase 2 of single touch payroll. Number 3, changes to company tax and tax rates. And number 4, trusts. On this episode, we are focusing on what you need to know about changes to trusts. So let's go. Hi guys, Nathan Rigney here, the profit generator, founder and owner of NGR Accounting. If you want to continue to watch our awesome content, remember to hit that subscribe button, click the reminder, and like this video. The last thing I would like to go through is changes to trusts. If you have a trust, whether it is a structure that operates your business or holds family investments, it's important to understand some recent changes. When you initially set up your trust, you should have received a lengthy document that for most people could cure insomnia. It's also known as a trust deed. The trust deed sets out the rules for establishing and operating your trust. So, it's an important document that in a lot of circumstances, accountants and lawyers will often refer to when guiding trustees making decisions. A trust deed can shape decisions made by trustees. It's important to update or alter the rules of the trust, particularly when applying recent amendments to tax laws. Updating your trust deed ensures that you not only take advantage of the legislative changes that benefit your trust, but also comply with legislation which could benefit the trust and its beneficiaries. To change the trust deed itself, you must execute a deed of variation. This is a document that updates the relevant section of the original trust deed. The deed of variation forms part of the documentation of your trust and details how the trust deed has been changed over time. This, of course, is something that NGR Accounting can assist you with. So Division 100A is one of the massive changes we've had recently, and anyone with a family trust, also known as a discretionary trust, will want to take note of what I have to say here. Many trustees have appointed trust distributions, an income to a beneficiary who is on a low tax bracket and typically won't actually have a real benefit from the distribution. Division 100A is designed to put a stop to this. Division 100A is a section within the Income Tax Act 1936 that is designed to put a stop to income appointed to a beneficiary who is not having a direct benefit from the distributions. In basic terms, the ultimate benefit of that distribution needs to be received by the person the trust has named, or the beneficiary, or the sum of that distribution relates to expenses that the beneficiary would have incurred. So, i.e. expenses the trust has paid on behalf of the beneficiary. The key thing to highlight here is, has the beneficiary received the benefit? We need to also question if the distributed amounts related to expenses the beneficiary would have paid personally. Should the ATO find that the rules regarding distributions have been ignored, Division 100A will apply. This, in broad terms, means the amounts distributed would be disregarded and instead tax would be imposed on the trustee at the top marginal tax rate of 47% plus a Medicare levy of 2%. So what should you do? This is still pretty new, and even at the ATO level, which means many accountants out there are still working through how to apply Division 100A. So here's a profit generator tip. For any distributions being made, especially to young adult beneficiaries, is that you keep and maintain records of amounts that the trust has paid on behalf of them. As an example, receipts of university expenses, a record of rent paid, invoices for amounts reimbursed, or bank statements showing cash distributions being paid. But there's also some good news on the horizon. Division 100A does not apply if you distribute to a person under a legal disability, typically a minor under 18 years old. So some key takeaways. Division 100A is not saying you cannot distribute to a young adult or even a bucket company. It's not about whether you can appoint or allocate income to a beneficiary. It's all about whether they receive the benefit or not. So there is not necessarily a problem in allocating income to a bucket company, but there might be a Division 7A issues to deal with, making sure that the actual benefit is given to the company. Same with allocating income to a young adult beneficiary as a second example. It's making sure they too get the actual benefit of the distribution. Of course, I know this can get confusing and complicated, and we recommend that if you want to discuss this further, to make an appointment to have a genuine conversation with us here at NGR Accounting. So, this is the last of the 4-part series on things every business needs to know for this financial year. If you missed the other 3, they are available on our YouTube channel, and they included changes to the super guarantee, changes to single touch payroll, and revisiting company tax and tax rates. If you want to continue to watch our videos, remember to hit that subscribe button, click on the notification bell, and like the video to be sure to get all our awesome content. If you want us to share anything specifically, please feel free to email us at info@ngraccounting.com.au and we can do a video on it. I'm Nathan Rigney, the Profit Generator. I look forward to seeing you next time.